Hello. So let's start the descriptive part of your question paper, which is section C. Section C contains three questions, two 15 marks question and one 10 marks question. Okay. So let's start with the 10 marks question, which is this one, question number 46. Yeah. So the requirement, let's go to the requirement first. The requirement, the first thing you have to notice is that the requirement will not be one. There will be several requirement which is sub required as A, B, C, or inside each requirement there will be some other requirements which is noted with some other references. So the main thing you have to notice is that whenever you are writing your answers or whenever you are putting your answers in the answer sheet, which is CBE or the written examination, what you have to do is you have to clearly make sure that the reference number is there. All right. So whenever the valuer is going to value your answer, he should not be confused with which answer this is pertaining to. Okay. So you should make sure that the requirement is clearly mentioned in the sheet which is provided to you. If it is not clearly mentioned, you have to write the requirement reference first, then you have to write the answers. All right. Yeah. So this question has three requirements, A, B, and C. All right. First one is calculate Kagan's revised income tax liability for the tax year 2019-20 if he retains some inherited shares. All right. I don't know about the story, so we have to go to the scenario to get the answer of this one. And the second requirement is explain why little or no capital gains tax will be payable if Kagan sells some of his inherited shares. And the second part of the second requirement is calculate Kagan's revised income tax liability for the tax year 2019-20 if he sells some of his inherited shares and makes the four alternative investment. And the last requirement is for each of the four alternative investment, state whether the investment will reduce Kagan's potential IST liability compared to him retaining the inherited shares. So by reading this requirement, I notice that it is not only a question which is pertaining exclusively for a particular type of tax. It has some part of inheritance tax, it has some part of capital gains tax, but majority it has the income tax part as well. All right. So let's clear or let's solve one by one. First one is calculate the revised income tax liability if he retains some of the inherited shares. Okay, let's go to the scenario. You should assume that today's date is 4th April 2019, which is the previous tax year. On 2nd April 2019, Kagan inherited some cotton ordinary shares valued at £510 following the death of his aunt. Kagan is unsure whether to retain the share or sell some of the shares in order to make some alternative investment. Okay, so by reading the first paragraph, I got to know that Kagan is the main person in this question. Kagan got some shares from his aunt. Okay, that was inherited due to the death of his aunt. Inherited means it is transferred due to the death of his aunt, and he had the shares valued at £510,000 with him. And currently, the issue which he is facing is he's unsure whether to retain the inherited share or sell the inherited share to realize the amount. Okay, so this is the main scenario. And Kagan is aged 61 and is an additional rate taxpayer. Prior to inheritance, his taxable income consisting entirely of employment income for the tax year 2019-20 would have been 400,000. The only source of income he had was employment income, that was 400,000, and the income tax liability on this income for the tax year 2019-20 would have been 165,600. Prior to receive the inheritance, Kagan's chargeable estate for the inheritance tax purpose valued at 1.7 million and IST of 550,000 would be payable were he to die in the near future. So he already calculated the death estate tax as well. If he is dying in the near future, he has to pay 550,000 of the amount as death estate tax. Yeah. So the first paragraph or first subparagraph is his first option to retain the inherited share. That means he's not going to sell the share which is inherited from her aunt. He is going to keep that share as it is with him. Okay. If he is retaining the inherited share, what would be happening is that if Kagan simply retains the inherited share, then he will receive dividend income of 15,300 during the tax year 2019-20. This is an addition to his employment income of 400,000. Okay, so this paragraph itself suffices the steps, so suffices the data which we require to answer the first requirement, which is requirement A. Okay, so let's go to requirement A again. Requirement A is a 1 mark question. You don't have to spend a hell lot of time on this because it's only 1 mark. All right. So that will be that much easy for you to calculate that one. So the question is to calculate the revised income tax liability if he is retaining the inherited share. It means that if he is retaining the inherited share, he would be receiving an additional income in excess of his employment income, that is dividend income of 15,300 pounds. Okay, so already there is an income tax liability calculated based on his employment income, that is 165,600 pounds. We are supposed to calculate the new income tax liability if this 15,300 of dividend income is also added to his income portfolio. All right. So what would be happening is that his employment income is 400,000 and the income tax in respect of that is 165,600. This is the figure which is given in the question. All right. So now what's going to happen is if he retains the shares, he would be getting additional dividend income of 15,300. Yeah, this additional dividend income will be causing an extra income tax liability that is calculated as follows, like nil rate band would be there, that is 2,000, which will be taxed at 0%, and there would be the extra amount remaining balance, that is 13,300, which will be taxed at 38.1%. You know why? Because already his basic limit, higher limit, and additional limit is crossed. Right. So since his employment income is 400,000, dividend income cannot use the basic limit again because it has already been used by the employment income under the non-savings income heading. Okay. So his 13,300 will be taxed at 38.1%, and the income tax liability of that would be 13,300 into 38.1 percentage, that is 5,067. So the revised income tax liability is 165,600, which is his old liability, plus 5,067. So the new liability would be 170,667 pounds. Okay, so this is enough for the 1 mark requirement they have asked. All right, so he already had the income tax of 165,600, and if additional income of 15,300 is added to the dividend income, the new income tax liability would be 170,660. Yeah. All right. Now let's see what does requirement B. In requirement B, you have to notice one thing is that requirement B has two parts, part 1 and part 2. All right, so you have to put the reference accordingly in order to make sure that the valuer will not be confused with the valuation of your answers. Okay, so we are going to do the part 1 of requirement B, that is explain why little or no capital gains tax will be payable if Kagan sells some of the inherited shares. Okay, let's see what happens if he sells some of the inherited shares which he received from his aunt. Okay, so the first sentence of this one, Kagan is considering selling some of his inherited shares for which there has only been a minimal increase in the value since he inherited them. Enough, we got the answer. You know why? Because if he is selling some of the inherited shares, there would have been a gain arising. Okay, but clearly here it is mentioned that since the time the shares inherited to them till the date of disposal, there had been a minimal increase in the value of share. Okay, that means that proceeds which he gonna get if he sells the shares and the cost at the time of inheritance, the difference between these two figures will be very minimal. That would have been covered with the annual exempt amount that is to be received to Kagan. Because Kagan is an individual, here it is clearly mentioned that Kagan will not make any other disposal during the tax year 2019-20. It means that his annual exempt amount is unused. So whenever you are coming across this sentence, that a particular person does not make any other disposal, if this sentence is referred in the question, you have to keep in mind that this sentence is given in the question only to make you aware that his annual exempt amount is unused. All right. So if he is selling some of the inherited shares which is having minimal increase in the value since he inherited them, it means that he will be having very minimal gain. That minimal gain will be payable or will be covered with the annual exempt amount. So his capital gains tax would be zero or will be a minimal amount. So the answer is there itself, that the second requirement was asked why there will be minimal income, minimal capital gains tax or no capital gains tax if he sells. If he sells the shares, the gain arising on the disposal would be very minimal since there had been only minimal increase in the value of share. Okay, the gain arising on the disposal would be covered with the annual exempt amount since he is not making any other disposal in the tax year. So that capital gains tax or the taxable gain arising on that disposal will be very minimal or it can be zero. That's why Kagan will not be required to pay any capital gains tax, or the capital gains tax that will be liable will be very little. Alright. So the answer of the first part of second requirement is that. Now let's see what is the second part, which is the main part of this question, that is having 6 plus the professional marks, that is 2 marks, total 8 marks is allocated for the second part of your second requirement. The second requirement asks you to calculate the revised income tax liability for the tax year 2019-20 if he sells some of the inherited shares and make the 4 alternative investment. Okay, perfect. So if he sells the inherited shares and make the investments, which means he is selling the inherited shares, getting the amount with him, and he is using that money to make 4 other investments. Okay, he is not simply keeping that money in his pocket or in his bank account. He is going to use that money to make other 4 investments. What are those investments? Let's see. Kagan will make a gross personal pension contribution of 100,000. Kagan is a member of pension scheme but has not made any contribution in recent years because of his income has been substantially lower than it is for the tax year 2019-20. He therefore has sufficient unused annual allowance to cover the pension contribution of 100,000. Kagan will immediately withdraw 25,000 of the pension fund tax-free. This is permitted 25% tax-free lump sum. However, no pension will be taken during the tax year 2019-20. So from this part, it is completely clear that he will not be incurring any additional income tax liability on this spent of 100,000. You know why? Because additional income tax liability would have been arised if he is making contribution that exceeds the annual allowance amount, or he is withdrawing the pension from fund which is more than 25% of the lump sum. All right. So listen again. The tax liability on the pension contribution can only be arised if he is contributing an amount which is more than the annual allowance amount, which is not here in the case, because here it is clearly mentioned that the amount of 100,000 which is going to contribute in the pension is covered with the annual allowance amount. So there is no confusion on that. All right. So there is no additional income tax liability on the contribution. Also, he is withdrawing 25%. He is only withdrawing 25% because 25% is permitted and it is tax free. If he has withdrawn 30% or he withdrawn 40%, the extra amount that is in excess to the 25% would have been taxable. But in this case, he is only withdrawing 25%. It means that there is no additional income tax liability on the pension contribution. All right. Yeah. So let's write the answers as well along with this one. So we are supposed to calculate the income tax liability. Let's go with the format itself because this is the descriptive part. We have to keep the format in order to get the step marks. All right. So in the description, the first thing which we have to write is employment income. Then he has the pension income which we just saw. All right. Other incomes we can write afterwards. Since it is the descriptive part, we have to maintain all the formatting things. So here I'll be putting the symbol of pounds as well. So in your exam, in the CBE, there is an option to put the currency symbol, which can be pounds, dollars, euros. So you just have to use pound symbol for your TS examination, right? So employment income is 400,000, which was already given. Pension income I will be putting 0. You know why? Because no taxable amount is being arising as a result of the pension contribution. So I'll be putting 0 under the NSI. Okay. Now, what is the next investment you're going to make? Kagan will invest 50,000 in premium bonds. The expected amount of premium bond price which will be receiving during tax year 2019-20 is 700. Premium bond is an exempt income. We already learned this under the income tax topic. So premium bond we will be writing here, and we have to put the 0 under the NSA in order to make the valuer aware that premium bond are exempt. If you're not writing the premium bond and pension income, you will not be getting the mark allocated for this one. So the examiner has clearly told you that whenever you come across the exempt incomes, you have to write the description and to put 0 in relevant columns. Right. So that's why I put the premium bond description and put the 0 over the NSA column. All right. So second investment is also gone, and third is Kagan will invest maximum permitted amount of 20,000 in the cash individual savings account. ISA will pay interest of 400 during the tax year 2019-20. Individual savings account. Interest from individual savings account is also an exempt amount. So we have to put 0 under the SI because it is interest. Okay. So interest from ISA is also exempt amount. So that is also done. And the fourth one, Kagan will purchase a freehold property for 295,000, including all cost of the purchase. Property will let out unfurnished. Kagan will receive property income of 9,600 during the tax year 2019-20. So that is taxable. Which one? The amount of 9,600 received as property business income. So we have to write property business income and 9,600 under the non-savings income. Yes. Yeah. Now see, after making these 4 investments, Kagan will be left with 65,000 of inherited shares because he is not completely selling his shares. He has shares which is valued 65,000, which is in his hand, and he will be receiving a dividend of 1950 from the shares which is retaining after these 4 investments. So that dividend income will also be shown here as taxable amount 1,950. Okay, so these are the only items under his investment. Now we can do total income, which is simply the sum of all these figures. Right. After that, deductible interest, if any. There is no such deductible interest you can see here, so I will be putting 0. After that, you will be getting net income. Net income is same as of the total income since there is no deductible interest. And after that, we will be deducting personal allowance. I know there is no personal allowance will be applicable in this question since his amount is more than the limit. But I'll be writing these items. You know why? Because these items will give you the step marks. Okay, so you are not supposed to deduct the personal allowance from total income. That's why I deducted deductible interest first, then converted it into net income. Then I deducted the personal allowance amount. Otherwise, it is wrong because you are not supposed to deduct the personal allowance from net income. You have to deduct the personal allowance from you are not supposed to deduct the personal allowance from total income. You are supposed to deduct it from net income only. So that's why I converted it into the net income part. Then I made the personal allowance line and put it 0 since the amount of net income is more than the limit, right? Yeah. So I got the taxable income. Okay. Now we can calculate the income tax liability. First, I will be calculating for NSI. For NSI, since there is no gift aid donation or personal pension contribution, let's see where there is personal. Yeah, this one is a personal pension contribution, right? 100,000 is a personal pension contribution. All right. So since this 100,000 is personal pension contribution, we have to do the steps which is exactly same as of the gift aid donation. Yes. So since there is gift aid donation steps, we have to change the basic limit and higher limit, which will be 137,500 and 250,000 pounds. Normally, the basic limit is 37,500 and the higher limit is 150,000 pounds. But in this case, what happens is we have to put the working note over here. So we'll be getting the mark for the working note as well. Working note for personal pension contribution. First, gross amount of pension. Gross amount of pension is 100,000. Second is adjusted net income, which is